Hello everyone, myself CA Hari Venugopal from Aja Commerce Academy, Hyderabad. In this lecture, we shall be discussing about the basics of systematic and unsystematic risk. This is covered in your chapter Portfolio Management of AFM. What could be the basic risk of holding an asset? Say security or equity shares. What would be the basic risk, the simplest risk to understand? It is, what if the value of this asset comes down? What if the value of this security comes down? What if it is of no value to any person? What if I am unable to sell this in the at least at the rate which I bought it, right? So that itself is the biggest risk, and that is the only risk. All the risks which we classify or we explain as systematic or unsystematic, everything is based on this particular risk of the value of that particular asset coming down or fluctuating. Now there could be multiple reasons for this to happen, the value of that particular asset coming down or changing. And the classification of risk as systematic or unsystematic is basically based on these reasons. Now we call it as elements. So let us say, what is systematic risk? Systematic risk is the risk which is inherent in the system overall, like the overall economy. That is the system's risk, or that particular risk which is inherent in the economy or the macroeconomic society. So this systematic risk will affect almost all securities. It will affect all industries, and it is difficult to manage, comprehend, or reduce or mitigate. Whereas unsystematic risk is a risk which is specific to a particular company or a particular equity share. It is not for the whole economy. It is only for a particular economy, or only for a particular company or a share. And this is much more easier to control. So before going into the definition, I'll give an example. So recently Corona had hit everyone, the whole market. We would call that as a systematic risk, because that was there in the system. It is not specific to a particular company. But suppose, let us say an example, a company, its sale went down due to any reasons, like there was a huge fire in the machinery or in their premises, and all of a sudden people got panicked and they started selling the shares. That is only for a particular company or a particular share. So that is an unsystematic risk. Now systematic risk alone we can again classify into three. So in systematic risk, say, what if a particular market interest rate changes? There are certain cases key, for example, a particular company or is giving you an interest dividend of 10%, but all of a sudden SBI started giving you 15% or 20%. That means in the market the interest rate has gone up due to some or the other reason. So usually in such situations people will start selling all the shares. So it is not a company specific, it is for the market as a whole. People are no more interested in shares of any companies because SBI is giving at a very higher rate of interest. So this is interest rate risk in the market. This is also a systematic risk. Next, we are having, let us say we are getting 10% dividend from a company, or almost all companies on an average is giving 10% dividend. But what happens is that I am investing in a company, and this company is saying you will be getting almost 10%, that is my even expectations. But in the course of time, as years progress, there is a problem, inflation. After 2 years, the inflation was so high in the market, it hit almost 40%. So anything which I am getting last year or 2 years back is of no value to me. So earlier a company was paying me 10% return. Now after 2 years, if still it is paying 10%, in that 10%, 40% is taken by inflation. The real return which I am getting is of no value to me. Like nothing is available in the market with this 10% so that I can make my own personal purchases. So inflation is also one of the risk which is systematic, because this will be impacting all the companies in the system. So inflation risk, this is aka also known as purchasing power risk. And the third risk is the market risk. So whenever market risk, see what happens with respect to equity shares and share market is that market fluctuations always will impact your overall share ka performance. Like in market we have recessions and upsides and downs. So whenever the whole market is down, it will have an impact on all the shares in the market. So that is the market risk. Also if you see beta is the measure of risk. Any company ka beta will be always factor to the risk of the market as a whole. So market risk will be always proportional to each individual security which is there in the market. Anytime if your market is going down, it will always impact the security. So these are the three types of systematic risk.